are going to be discussing a great topic today, which I have already retermed as the turf war of e-commerce and the internet versus brick and mortar. Although I don't think that that is the actual official name of today. I believe it is retail's merchandising problem, the official name. You can find all of this recorded at our RE-Talesio website. It will have a transcription if you would rather read than listen to our sometimes annoying voices, or you can watch it on YouTube, however you prefer to get your very awesome Retails IO fix.
Yes.
There you have it.
Yeah. And by the way, the chain, can you please show us the turf war gear that we have over here?
I have my gold chain, just in case you're all wondering. I have my handy dandy headband. It's actually my running headband that I think also does the trick. And that's about all I got for you today. I'll show up with a little more accessories next time, perhaps. Maybe. Like a big ship or something.
I did not get the costume memo, you guys. I just want to say, like, really, I need to know about this next time.
Yeah.
I'll give everyone a little more of a heads up. This was very spur of the moment. I didn't want Shlomo to tell me no, so
No.
I like it. That's my method too. Ask for forgiveness, not for permission.
Yes,
Yep.
I'm with you. Oh, so funny. Awesome.
Beautiful.
Well, I'll hand it over to Shlomo to keep us moving here before I take us off anymore.
Alrighty, so we're here to introduce Najla. Najla is a innovation and marketing extraordinaire. And Najla, why don't you do a better job than me introducing yourself to the crowd?
Well, you always do such a good job of introducing me. That was a pretty crappy one. So I'll take the lead here. Thanks, Shlomo.
Yes, I have failed you, Master. Sorry.
No, just kidding. Hi, guys. My name is Najla Kayyem. I'm the Executive Vice President for Marketing for Pacific Retail Capital Partners. In this role, I oversee all of the comprehensive branding and strategic communications and innovation, repositioning, PR, omni-channel initiatives, and all of our digital initiatives for our shopping center and mixed-use assets located across the country. Prior to this role, I was CEO for SickFit, which was a national lifestyle brand focused on functional fitness. And prior to that, I spent about 2 decades working in the commercial real estate space for developers such as Westfield and Caruso and Red Development, related companies. And so in those roles, I was able to launch and market some of the nation's largest mixed-use landmark projects in the country, working in a variety of capacities from the pre-development side through the asset management, leasing, and marketing to really create a sense of place and space for those, for those assets. I also have a firm called Kayyem Marketing, where we have a group of consultants that work across the retail consumer real estate spectrum, so essentially anywhere that transacts, and they help to really market services and products and places and spaces for various developers and operators across the country. So I've got 2 kids, Cannon and Camille. I live in Scottsdale, Arizona, and I'm excited to talk to you guys today about really bridging brick and mortar with D2C brands and creating a true omni-channel experience that's seamless for the customer, where the customer can get what they want, when they want it, how they want it, where they want it.
Beautiful. Thank you so much. So the reason you're here today is because, first off, you're, aside from me, probably one of the coolest people out there. That's for starters. And okay, Jessica, I'm sorry, and everybody else who's attending. Okay, we're all just as cool. No, but on a serious note, so Najla works within yesterday's retail space, within the mall environment, right? Najla works within a shopping center environment. We're here to talk about why aren't more cool brands in the shopping center, in the mall? How do we make that happen? What are some things to do that? So, there are challenges. Landlords can help. There's structural finance issues. There's stock issues with regards to pop-ups. Najla, I mean, if there was, in the shortest way, like, what's the underlying issue as you see it ultimately, and what can the brands do? What can landlords do to sort of change that or work towards changing that?
Yeah, I think fundamentally, direct to consumer brands are not set up to have a brick and mortar experience in the traditional way that traditional legacy operators have had them before in the past within four walls. A lot of them do not have the resources, they don't have the capital, and they don't have the wherewithal or the know how on how to even start or how to build out a space and then how to operate it and have it to be productive. A lot of challenges also come into play when your occupancy costs are higher than 15% of your total sales volume, which makes it really tough to be profitable and really tough for those groups to do business. So essentially, I think it comes down to a couple of things. Number one, build outs and getting a store, customer ready, whatever that means, staffing and having a team around you that understands, the environment of a brick and mortar space, customer service, which typically when you're doing business online is very transactional versus a little bit more warm and fuzzy. And just not having various departments within organizations or within brands in order to fulfill all of these capabilities. And then financing also comes to play. The money is always the most paramount issue. So I think there are a lot of different issues that we can tackle and we can certainly talk about today.
Got it. So I'm hearing you say there are structural issues that need to be fixed, right? Obviously, Rome wasn't built in a day, although many people like fiddling like Emperor Nero as Rome burns right now. But I guess the question is like, where do you think we start, right? I mean, there's so many things to tackle, so many problems. Where do we start? On whose shoulders does this lay to start? And what would be your suggestion for the industry, for all the industries, just to get this moving?
Yeah, so I think that right now, direct to consumer brands have a tremendous opportunity. As cities have been emptying out a little bit and people are moving to the suburbs, landlords, specifically in suburb markets, are looking to ink deals and are looking to be a little bit more aggressive. And digitally native brands definitely have a chance to accelerate their brick and mortar strategies and their offering right now, given the current market conditions. So that's certainly one way to capitalize on that. There are significant ways for brands to partner with various landlords. Number one, it's first of all getting in touch with them, right? So if there's a local leasing or a perm leasing or a marketing person on the ground managing that asset, having that connection, I think, is really important. Also, looking outside of traditional, primary markets outside of New York and Boston and LA and specific areas like that where D2C brands tend to go first. Looking at secondary and tertiary markets as opportunities, I think, is a big opportunity also right now. And focusing where the brand, CEO or founders or executive board, where they can control and grow in a smart way, right? Not like just splattering it out around the country, but creating specific clusters or regions where they can really make an impact and really drive that customer to acknowledge their brand and to help grow their sales.
Najla, I had a question for you. And I was actually just really curious if you went back about 5 or 6 years and you were doing a lot of outreach to a lot of digital native brands, what's changed? Because when I joined the founding team, the founders at the Honest Company, it was pretty clear to me just across the environment with a lot of hip and cool entrepreneurial, like very lovely people. But it was very common. People would just corner me and say, why would we ever open retail? Actually, a better question is, why would anyone ever go to retail? And so it was pretty clear at the time, 6 years ago, that there wasn't a big enough carrot or stick, or really just frankly a motive, right? What do you think's changed from kind of the mid part of the last decade to today, or has it really?
Yeah, I mean, well, the pandemic certainly accelerated and changed a lot of things. It created a lot of fabulous space that's open and available now at a fraction of the cost that you could have had it, or that you would have had it 4 or 5 years ago. I would say maybe 2.5 years ago, right before the pandemic, lots of developers were hot and heavy on bringing in direct to consumer brands, but they don't pay the rents that you traditionally get with legacy retailers. So we actually at creating marketplaces and spaces, a la the show fields, the neighborhood goods type of an experience where you're aggregating a bunch of DTC brands under one roof, and you have one operator and one person that you're dealing with that then can manage all of those subsets and brands. So I think that that is something that we really heavily looked at prior to the pandemic, and now that we're coming out of the pandemic, there's a lot more opportunity to do business with specific brands, with onesie, twosie, individual brands, to give them a operating platform in order to be successful. We're all very well aware that when you have a brick and mortar presence, it actually helps your online sales. And when stores close their brick and mortar presence, it actually hurts their online sales. So both of those things need to be synergistic, and they need to work together, and they need to be symbiotic. And right now, they're broken down into different business units. So, retail, when you purchase in store, is one business unit and one sale, and then when you do it online, it's a totally different one and a totally different department sale. And what really needs to happen is those pieces need to blend so that it's one brand message and one brand communication versus segmented silos and segmented channels.
Okay, Najla, I have not so much a question, but more of like a comment that I would like to hear your thoughts on. So my agency helps direct to consumer brands with all of the things that you named as kind of these barriers to entry, right? So we'll act as an outsourced retail department until the brand can get on their feet and help accelerate their progress. So everything from helping them understand what a build out takes to RFPing designers, securing GCs, all the way through operations, training, creating a branded selling ceremony, you name it, we'll make sure your store gets open. So I'm working with several brands right now to do that. And it's been really interesting because one of them in particular is opening in a mall for the first time. And I'm not going to out the mall, and it's not quite public yet for the brand. So I'm not going to say which ones, but you'll know soon enough. But it was interesting because the mall wants this tenant. The mall knows that they're a direct-to-consumer brand that's pretty young in their retail journey, but yet after they signed the lease, they were kind of like, here's the tenant requirement documents, and it's like 3 pages long, and they have to do a reflected ceiling plan and renderings and this, that, and the other. And I was like, no, guys, we don't have time for that. Please go back to them. And so then they shortened it to 1.5 pages. Okay, fine. Now they're like, oh yeah, you have to put a barricade up with a vinyl. And it's like the malls are like, we understand that you want a short-term lease and we want you in, but we're still going to hold you to the same standards as we always did for like a 10-year lease. And I'm not understanding like, where is that coming from? And like, how is a direct to consumer brand supposed to kind of walk in and now walk into this short-term lease? You know what I mean?
Yeah.
Jessica's like waving. Yeah.
Yeah, well, those standards and design criteria are set up the asset for success for the long term. So I'm a proponent of having those in place. But there is wiggle room. If you're doing a short-term lease, then you're probably not spending the capital to build out your own space, and you're probably taking a vanilla shell space or some type of a space that is second generation in use. And so you have to, polish it up to the best of your ability for whatever your use is. When it comes to barricades and graphics and signage, the customer needs to know what's coming, and it's got to look presentable for them while you're under construction. So there are ways to coordinate and work together on those different elements. Does it come down to, who pays for it? Is that really where you're struggling?
No. It's more of just like, well, one, it's time, right? Because they sign a less than 12-month lease. So of course they're not getting a ton of free rent, right? Like you're not going to give 3 months free rent on a less than 12-month lease. So it's a time thing, but then it's also like, for me, and I understand that like you're on the landlord side and I'm on the brand side, and I totally get the landlord side. Trust me, like you want your mall to look nice, and this is a very nice mall. So like I get it. But I think what I would love to find out is like, what are the landlords doing to kind of help like come along with those direct to consumer brands? You know what I
Well,
mean?
they
Like,
should be
is it,
hand holding. I mean, you're typically, if you're doing a short term deal like that, you're working
this
with like
one's
a
not.
specialty leasing manager. You
Yeah.
should be the local on-site management team should be holding your hand if you're a local tenant, if you're a specialty leasing type of a deal, and walking you through this. They typically deal with operators who are not so savvy, who are not legacy retailers, who have pop-up type experiences, carts, RMUs, those types of things, and they're used to working with groups that they have to handhold and get to the next level and the next point. So I would probably challenge that the operating team on the ground that you're working with maybe isn't as seasoned, or maybe they don't have an operating team on the ground. That's another challenge that we see with REITs versus private, capital or individual shopping centers that might be owned and managed on a local level. When you're in a REIT environment, typically they're focused and taking care of their trophy assets. And so you've got your A team focused on this band of assets, and there's not a lot of attention happening in the middle. And so they might not have somebody on site. So I would recommend, if someone was looking for a space, that they connect with the on-site management team and they have somebody there who is strong that they can connect with and work with and collaborate with and develop a customized strategy and marketing plan that's going to work for that tenant. At the end of the day, it's a partnership. The landlord needs the tenant just as much as the tenant needs the landlord. And the goal is to drive value for the retailer and for the asset. So we do that through a variety of marketing efforts. Marketing drives traffic drives sales drive rent, and ultimately rent drives value. So it's a collaborative experience, and it's certainly not it shouldn't be a fighting experience. It should be something that's collaborative to move forward.
This is really interesting because I think what this boils down to is, and I think this is important for direct consumer brands to know, is that all malls are not created equal. And if you're going to go into your very first mall, make sure that they have the infrastructure in place to like really help you and hold your hand, because I know what you're talking about. Like, I've been in situations where I have a tenant coordinator and they're like, definitely, they're right there along with you. This situation has just been very interesting to me. So I wanted to get your take on it.
So I've got a little
And
bit of input.
is it a REIT?
It is not actually.
Okay.
It's not.
Interesting. Okay.
So, yeah.
So Rebecca, one thing I want to kind of add in, and maybe something that to think about in future on these, especially as you work with so many of these digitally native brands, going into a short-term lease process, would you ever give your clients, say, a upfront marketing brand guideline of this is what we're going to do upon opening, that you actually, your client would present with their LOI for a short term of, hey, here's our standard opening sign, here's our standard for what things look like as we're going through our construction, and this is what we've allocated towards this process and the timeline we have, and so that you almost can set a standard across the industry, at least for your clients, of this is our expectations going into this negotiation. We have a short term, and this is what we need to accomplish. If there's anything we need to tweak, let's tweak it as we're going here through the negotiation process, rather than signing this lease and then getting into a situation where we're spending 2 months trying to figure out what the sign looks like that's slapped on the front of the building or in front of the space as we're getting through our initial construction. So that's it would be cool to see a standard set like that across the industry, because your clients know their brand and they know what they want it to look like. So it's almost like providing our upfront signage to kind of tackle some of those issues up front.
Exactly. And I think that is always the goal. It depends on at what point my team and I come in. Oftentimes we come in after the lease is signed.
You're like, whoa.
Because the brand goes, oh my gosh, we don't know how to open retail. We need to go hire someone to help us. But it really is. It's like a chicken egg thing, right?
Yep.
So yes, the goal is a standardized process, and we are working toward that with this client. But I think, a lot of times the direct to consumer brands see this, rightly so, as an experiment at the beginning, because it is, right? So like, I wouldn't change that part. But then it's now like there's this disconnect between, like, malls are used to having these 10-year tenants with all of these standardizations. And that just frankly doesn't exist in direct to consumer.
Well,
I'm not to be hyperbolic, but like in some direct to consumer brands, let's say.
I don't think 10-year leases are anywhere right now. I mean,
Right.
we're not seeing that anywhere. So I think that's very old school, passe.
Hey.
Like, those are expiring right now. I mean, the most I've seen in the last 18 months is a 5-year deal, unless it's a big box that has a special interest in the asset. So we're seeing 13-month deals on term right now, the most popular to really help curb co-tenancy for those stores that have gone away. And you're seeing 3 to 5 year deals, where there's investment being made into a space. But where there's a vanilla shell or a pop-up type of an experience, I mean, it could be 3 months, it could be a year. And typically they don't invest a ton of money into those spaces. It's, paint and maybe some fixtures and some basics. But we certainly do expect that the signage is on point, that it doesn't look temporary, that it looks cool and effective and people want to go there, and things, there aren't handwritten signs and everything's printed well. And there's a specific aesthetic that is met in order to meet that criteria.
Yep, absolutely.
So it's pretty interesting. So one, obviously, coming from the finance perspective, I think one of the major issues with working closely with digital natives, take away the communication issue, which obviously you guys have highlighted to be like the key thing over here, where if you just can coordinate properly, then you solve a lot of the issues. But I think the other thing is that, signing with a smaller brand with a lack of credit could be an issue. But Najla, as you say, is like, hey, 10-year deals aren't getting done. So even if you have the best credit in a 5-year deal, it's still not going to make an impact on the credit of the shopping center because you don't have necessarily those longer term deals. So I guess the question is, I mean, do you feel from a commercial real estate finance perspective that people are getting the memo, and does that mean that banks are not going to finance retail projects, or they're going to and I get your space isn't finance, but I know you sit in those meetings.
Yeah.
So does that mean that banks are adjusting to it? Or does that mean that banks are
Yeah,
sort
I
of
think they're
shying
adjusting
away?
to it 100%. I think dislocation leads to opportunity. Right now, there's reduced liquidity. The CMBS delinquencies and significant cap rate expansions have created a tremendous amount of opportunity in the shopping center business. I think if you look at it as a snapshot in time right now, this is the most lucrative, deep valued, and distressed debt investment opportunity since the global financial crisis began. You're seeing bargain pricing currently at the shopping center level, at the retail level. It's an asset class that's out of favor right now. So there's tremendous amount of opportunity. There's a ton of retail, in the country, and shopping centers specifically. You're seeing those reduce. I mean, I think there's 1,200. I think last I checked, there was like 1,000. We're expecting it to shrink down to about 600 nationwide over the next 5 years of, Class A assets, maybe some B plus assets that have a reason to exist in a specific community that warrants them being there. And those assets need to evolve and develop over time. You can't just create something, expect it to be like that forever. So these operators and developers and owners need to reinvest in them. And so every 10 years, there needs to be a refresh or some type of an investment. And right now, we're seeing the opportunity to master plan based on looking at assets as a covered land use play and unencumbering space in order to rezone and to re-entitle in order to densify to create more value. We're buying a lot of department stores and doing some sale leasebacks. And then once those department stores, because they are becoming obsolete, go away and decide that they no longer want to operate, that space is getting redeveloped into an adaptive reuse that makes sense for that community and that space in that area.
I see adaptive reuse happening in my own backyard. I mean, it's definitely something that's happening. And I think what will actually come of the adaptive reuse is better, more experiential retail that fits our current market demand for retail, because retail has been sitting, and Shlomo and I get in this all the time. We sat on this edge of like, brick and mortar's dead, the Amazon effect. And we talked about this for like 10 plus years. We go to every ICS scene. It's like, oh, brick and mortar's dead. It's like we had this for so long, but now we've been kind of pushed off the cliff that guess what? We are going to have adaptive reuse. We are going to have to change the way we build retail, because even though we've been talking about retail being dead for 15 years and Amazon effect, nobody stopped developing the way we had been developing for the previous 30 years. So now being over this proverbial cliff, I think is a really great thing for retail as a whole to be front and center once again. And right now, obviously, we're seeing industrial space kind of the belle of the ball, but I think our retail prospects are looking good to come back strong. like the West Coast in 1994.
Well, here's the interesting thing, and anyone who's not in the real estate business itself, and just looks at economics just from a cyclical perspective, right? And e-commerce has taken a big bite out of retail, but e-commerce is just not profitable as a standalone. And we spoke multiple times about how combining them together is the right way to go about it, right? Yet real estate owners and developers are not waiting around for that because time is money and time is loss of property, and then redeveloping properties, which means in a certain way it's being blown up, and there's an opportunity to build up from the ground again once retail recovers. Heck, we talk about, Najla mentioned department stores are relevant, and yes, U.S. department stores are relevant, but I mean, take a look at, Selfridges in London. I mean, that's killing it, and it's a department store, right? Like, what's up? Well, unfortunately, we have department stores that have not stayed at the tip of their toes, if you will, and innovated. So, I mean, for anyone who's looking to innovate in anything in retail, I mean, the world is your playground right now. I think it's ridiculous.
Yeah.
So I want to pivot over to another topic here within this topic, and kind of going back to our turf war discussion here. I'm looking at a CB written article that kind of goes into demand for e-commerce users and how that has affected brick and mortar. So e-commerce accounts for, and these are 2017 numbers, 9% of total retail sales in the US. However, they account for about 30% of the total absorption of industrial space in 2017. So total absorption being about 236 million square feet, 30% of that attributed to e-commerce. So we have e-commerce that's obviously putting a lot of pressure on the industrial markets. Do we think that with some of these changes, as malls evolve, as retail is starting to evolve, and the adaptive reuse, it's going to start to take some pressure off of industrial, and what is now we're seeing huge issues in supply chain?
No, I don't think that's going to help it at all. I think, we're not including industrial into these redeveloped shopping centers that we're developing as places and spaces. It's a totally different use, a totally different traffic pattern. It's not inviting to customers. I mean, have you seen a mega industrial facility?
Oh, they're horrible.
They're awful. So
They're awful.
maybe in the C centers, right, and the stuff that is becoming obsolete, that won't have a presence anymore, or that won't be relevant anymore, sure, that stuff can certainly be developed into industrial. But we're seeing more of the likes of multifamily, Class A office, life science, medical buildings, health and wellness precincts, green space, those types of uses where people want to gather and spend their time. So again, it goes back to placemaking. Places where people want to go, and places where people want to stay, and places where people want to enjoy life with their friends and family.
Yeah, and that goes back to having that experience retail. You want to go, I think, what was it, a couple months ago, Shlomo, we were in a room on Clubhouse, and we got into, when was the last time you went to a mall that invoked like an experiential thought out of you? It like really tugged at you, and everybody in the room kind of laughed, and they're like, well, I don't know when the last time I've been to the mall is. So when we start talking adaptive reuse and getting this retail position back into experiences, I think people will return to the stores, which maybe has some long-term effect as these digitally native brands now start to look at brick and mortar and how important it actually is, because we know that brick and mortar actually drives sales for e-commerce. I mean, that's kind of like an undisputed, like everybody agrees on that point. So perhaps we see a shift away from just being digital native brands and turning into somebody who offers brick and mortar and also has the ability to, as Shlomo
Well,
says,
if they want to grow, if they want to get
Yeah.
bigger, if they want to add volume and add, a bigger footprint, then they certainly are going to have to acquire brick and mortar locations as part of their strategy. I mean, the cost to acquire customers online has become prohibitively high. I've been in the marketing space for 22 years at the onset of all digital marketing, and how cheap it was, to place ads. And we've seen that year over year incrementally double, triple, quadruple of what it costs to acquire a customer. So it also has to be acknowledged that many customers are going into stores but end up purchasing online, just like you mentioned. So it's a
Yeah.
place where you can become knowledgeable, where you can interact with the product, where you can test things, where you can see things, but maybe you necessarily don't want to buy it, right there, or lug it home with you, or you can't carry it. And it's a lot easier to have it just shipped to your house. And that's why I really feel that there needs to be a blend of both worlds. And it's really about the customer. You want to cater to the customer. You want to go where the customer is, so that you can be the most effective.
Najla, do you
So
see that these footprints continue to get smaller for brands as they come into adaptive reuse projects or malls in the future?
Oh yeah. I
Yeah.
mean, we're not doing, massive 10,000 square foot spaces unless they're a mini major, but you're looking at, short sheeting spaces, larger frontal footprints, just even doing, in some cases, I don't want to say adding industrial, but adding fulfillment to the back of their store, where half of their store on the back is on the fulfillment side and the front side is the sales floor, for lack of a better term, or more of a showroom experience where you can see it. We saw that a lot in the height of the pandemic when we had to actually close down shopping centers, but stores actually still had to fulfill. Right.
Yeah.
And so no one could go into the mall front or back unless you had an interior or you had an exterior entrance into your space, or they were let in with security. But very quickly, we saw that everything was being fulfilled out of that store. So employees, although they weren't transacting with customers face to face, they were still going into work, and they were still, packaging and fulfilling all of the orders that they were doing online, and they were still shipping all of that out. They just weren't transacting with a person face to face. But the landlord wasn't seeing the benefit of that sale because it was an online sale, although all of the work and all of the everything was happening within the four walls of that space. So I think that was a big reality check for developers and operators, and specifically for leasing teams, to go and try to blend the online sale with the in-store sale to have it count. Because in a lot of these situations, we do percentage rent, or we do percent in lieu, or
Yep.
break points that might be at a certain level where we're helping them drive sales, and then we get rent on the upside. So all of those are very prevalent issues, and all things that we're constantly talking about and seeing and hopefully evolving. And the more we can talk about it and integrate it, hopefully the better it gets.
yeah, and I just want to invite, if anyone has any questions, anyone wants to ask something or a comment, just raise your hand and we'll bring you up. Ryan, you got something you want to say?
I've got a question. Najla, I want to ask you, you made a comment earlier about secondary and tertiary markets as a potential opportunity. And just dovetailing on that thought, like the conventional thinking that we all are keenly aware of and have experienced is that if you're going to build a brand through the retail channel, you want to start with premier locations, and whether that be neighborhoods, cities, physical properties, whatever that may be. On the other hand, when you think about digitally native brands, what's unique about e-commerce is that it's geographically agnostic customer base, right? So what are you actually kind of seeing for brands that have dabbled in secondary or tertiary markets? Mm-hmm. Is it a story of we actually are using it as a sort of prototype? We see actually higher returns and profitability because we're not paying exorbitant rents. Demand isn't like, what's their sort of take on it from what you?
I think all of the above. I think the first and foremost, it's ease and convenience to where the founder or where the executive group is, so that you can quality control and actually roll it out in a smart and effective way. It's very hard to, open a store across the country. If you're on one coast and you open it in another coast, like, you just can't get there overnight or tomorrow or fix a problem when it becomes an issue. So I think proximity to whoever the head people are in charge of that brand is important. And what else was, yeah, I think proximity is probably the biggest kicker. And then just being really focused on trying new things, right? Not being all things to all people. With brick and mortar groups, with direct to consumer groups, you've got data. So you know where your sales are coming. So that's the other piece of it, is that you know where your product is being sold. So you can put your stores in areas where you know that those folks already have an affinity for your brand or for your product. And that helps, generate more wealth and generate more brand awareness and really propel that brand forward. So you definitely should look at your metrics and your data and where your sales are coming from and position those stores in those right locations.
So
Najla,
now,
I am
I'm
so
sorry.
glad that you said that about proximity to headquarters and founders, because oftentimes I will work with direct to consumer brands that go, but New York is our biggest e-commerce
Mm-hmm.
market, but we're based in LA or we're based in Salt Lake City, but we want to go open in New York. And I'm like, no, 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 no. You really shouldn't do that. You should open in your backyard because you can be there and you can learn faster and then take those learnings and then go open in New York or wherever it is. So it
Well,
sounds
and
like that's your
cost,
take as
right?
well.
Totally,
Yeah,
totally. And the
absolutely.
cost, the barrier to entry for cost, right? High Street, New York,
100%.
is significantly more cost prohibitive to go into than a shopping center where you've got the services and amenities and resources that are shared amongst the group. So that's
Totally.
another really, a really good reason to go into a dynamic shopping center experience is because all of those things are clustered together. Security is also always taken care of, and that's something that's at the forefront of a lot of retailers right now. When you're on a standalone, street or building or space, you have to really take the burden of doing all of that individually versus relying on some shared resources and other people in order to execute the operational piece of the business.
Yeah, so I just want to go back to what was being mentioned before about industrial, and I know you were waiting for me to say this, but if e-commerce is fulfilling from all these warehouses to 3PLs or others, where they have large warehouses and they switch to fulfill from store model, as you mentioned, some stores have the space in back. Why don't you think there would be a receding tide type of effect, or do you, or did I misunderstand that there could be a receding tide type of effect on the industrial market?
Yeah, I could, except the ones that I'm talking about are typically mom and pop type shops or smaller businesses that probably don't have the need for 100,000 square feet of industrial space in order to operate.
Got it. Okay, because we're in touch with a lot of 3PLs, talking to them, and they're full to the gills, right? And their only vacancy is like a small space here, small space here, small space there, on various racks. And some of them, in order to fill that, have catered to the small DTCs to try to bring them on board, and to try to fulfill from them. So yeah, I mean, it's really interesting. It will be really interesting to see, but it just goes back to the thing we said before. I mean, real estate's a time game. You got to pay interest to your lender every single month you have a non-performing property. You got to find a way to turn it around. So if that means taking your mall, turning it into resi, when you think that retail will come back eventually, that's what you do, because you can't bridge that gap where you got to pay that interest in that time period.
Well,
So
and
I
the
think
retail's not going to go away. We're just over retailed. So we're shrinking the footprint to make it more palatable, to make it make sense, and have the right
Absolutely.
types of tenants there that people want to visit and want to go to, and the right merchandising mix. I mean, I talk a lot about Mall 2.0, right? So
Yeah.
previously it was, 60% apparel, where we're seeing that shift to 25% apparel. So you're adding a tremendous amount of other things, services, right? Is something that wasn't typically within shopping center space. Food and beverage has gone from a sliver of 10% now to 40% in a lot of places. So we're rejigging the merchandising mix in order to accommodate what people want now.
Najla, I couldn't agree with you more on that point. I think that the Mall 2.0 is brilliant, and it's where we've been headed. And I think part of the ripple effect of retail and industrial, well, what we're seeing in industrial is because we have brands that didn't want to go into crap retail. There was no reason to go into retail that didn't seem like it was going to bring anything to the table for them. And I think now, as we're seeing this shift and retail is getting more interesting, I hope that it does take some pressure off of the industrial markets, because e-commerce and what's happening on the industrial side of the world right now is tough. I mean, it's almost zero vacancy rates in almost any major market you go into, and that's not sustainable over the long term. And I don't know that we could ever build enough to keep up with that demand, as e-commerce will continue to grow, as digital native brands continue to pop up, as 3PLs continue to try and perform. So I absolutely 100% am on board with Mall 2.0. I like that. I'm all for. I love the adaptive reuse and the way our retail is headed, and couldn't agree more. So
I mean,
we've now bridged.
yeah, I want to go good. I'm glad we can all get along now.
We can all see. I told you guys it didn't have to be a turf war. We could make this work. It's good.
One thing I would suggest to these brands that are out there looking is to find a good partner. Right? Not all landlords are created equal. They are all very different, and not all ownership groups are created different or equal. I was just with an ownership group this week that is responsible for a large chunk of part of the portfolio we manage, and they really put pressure and stressed that they wanted us to think outside of the box, that they are willing to take risks now, and that they're willing to do something different because the last 2 years and the last couple of years have kind of created a trajectory that has been in decline. And so what do you have to lose, right? I mean, I've been a huge proponent of innovation and coming up with new projects and programs and failing fast and picking up and trying something else. And, having a collaborative team, I think, is paramount. And so working with the on-site local teams that can make a difference and that can actually move the needle for those brands is what's going to make or break the success of that space.
Got it. So I just want to, as we wrap up over here, Najla, thank you so much for the time. It's a great perspective because, like I said, you're, from the marketing perspective, you understand what digital natives need to do in order to get customers. You deal with them on a daily basis. You're looking at, I mean, we've spoken some really creative projects and how to sort of get these brands on board. And then you see the things, being in the C-suite on the real estate side, working with some of the largest institutional capital with the properties that you guys actually manage. So that's absolutely great. And I want to thank you for being here, and obviously thank my co-host, the usual co-host over here. Thanks for bringing the swag. I gotta up your game next time. I don't know how you're gonna do it because this is pretty good. Maybe some henna tattoos or something. I don't know what it's gonna be next time. But
Are we talking about big ships next time? Because I don't know, I could come up with something good. I got like 3 weeks to figure it out.
We'll figure that out. We'll figure that one out. So thank you, Rebecca. Thank you, Ryan. So guys, we're going to post this as a video, as a podcast, and also as a blog post as well. After we finish stitching together all the various recordings and cleaning up all this audio, so you could visit our website at RE-Talesio. That's RE for real estate, retail for retail, Tales TALES.io. IO being tech. We're trying to tackle all the various components of this and bring it together. And our next episode coming up is going to be about how we can take on-demand manufacturing, localized on-demand manufacturing, and help solve our supply chain issue with all those ports that Ryan sees from his all those ships that Ryan sees from his backyard, backed up with in the Long Beach ports. And our guests are going to be Lisa Morales-Halebo and Brian Away, who are both VCs focused on supply chain companies, supply chain startups. So we look forward to having you then, and we'll let you know as soon as we get this video up. Thank you again, Najla. And
thank you.
Have a good one.